Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Luminar stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Luminar develops laser sensors that enable autonomous driving. The technology it uses is Lidar. Lidar stands for light detection and ranging. It is a remote sensing method that uses light in the form of a pulsed laser. Lidar determines the distance between itself and an object by monitoring how long it takes a pulse of light to bounce back. The company has extensively tested its technology to ensure safety even in the most challenging conditions. It operates in two segments: Autonomy Solutions and Component Sales. Most of its revenue is from Autonomy Solutions. This segment designs, manufactures, and sells LiDAR sensors and software to car manufacturers. The Component Sales segment designs and tests non-standard integrated circuits for government agencies and defense contractors. The company's software is expected to be part of Volvo's next-generation electric SUV. It was recently awarded its 100th patent. Patents can be a very valuable asset as they can be monetized when they're licensed out to other companies. The recent acquisition of Optigration will help the company secure a key part of the supply chain and increase the company's value and importance in the autonomous auto industry. Tesla's technology for autonomous cars does not use LiDAR. But if Luminar can prove LiDAR's superiority with autonomous vehicles, then Tesla may one day be Luminar's customer like Volvo is. According to Elon Musk, Tesla does not use LiDAR because it's expensive, redundant, and unreliable. Tesla's cameras and its computer can reconstruct a 3D worldview around the Tesla vehicle, which makes LiDAR non-essential. That's all according to Elon Musk. Last month, NVIDIA selected Luminar to help with their autonomous vehicle platform. That's a big win for Luminar, and their stock price jumped up when the news was announced. Luminar was funded by a SPAC, a special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. At the end of 2020, the merger was completed and Luminar received $590 million in cash proceeds. The SPAC that acquired Luminar was Gore's Metropolis. This stock is backed by big names like Peter Thiel, GoPro founder Nick Woodman, Volvo, and Vector IQ, the firm that helped Nikola go public. The company started in 2012 and is headquartered in Orlando, Florida. It trades on the NASDAQ and Mexican Bolsa. Let's get started with the model. This is a mid-cap company, 5.8 billion market cap. They're trading at $16 a share and they have 362 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow each year since they're really not bringing in much revenue at this point. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is a sales for the company, and that went from $13 million to $22 million. This is the company's income statement. The top line is the revenue, the sales. Below that is their cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, which is negative each year. Below that is their operating expenses, and then below that is their operating income, which of course is negative each year. This is the company's income statement from the latest 10Q. This gives us the first 9 months of 2020 versus the first 9 months of 2021. And this column is the third quarter of 2020 versus the third quarter of 2021. So the top line is the revenue, the sales. Their revenue went up from 4 million to 8 million. 5.7 million of their revenue was in North America, 2.3 million in Europe and the Middle East. Most of their revenue is from Autonomy Solutions, 7.6 million. It was under $500,000 from component sales. Here's an explanation of what Autonomy Solutions is. This segment manufactures and distributes commercial LiDAR sensors that measure distance using laser light to generate a highly accurate 3D map for automotive mobility applications. This segment is impacted by trends in and the strength of the autonomous vehicles and associated infrastructure and technology sector. Most of the revenue in this segment is the sales to car manufacturers. The component sales segment is in the business of development of ultra-sensitive pixel-based sensors. This segment also designs, tests, and provides consulting services for non-standard integrated circuits that are essential for systems to meet the requirement of customers. This segment is impacted by the automobile and aeronautics sector, as well as government spending in military and defense activities. The company spent $26 million in R&D, research and development. This is always going to be a big expense for this company because they're going to always need to improve their current products and develop new ones. They spent $6 million in sales and marketing, $36 million in general and administrative expenses. So since they're not bringing in much revenue at this point, they have negative operating income. As their revenue grows, they should become more efficient and eventually become profitable. They had a net loss of $51 million in the third quarter, $31 million in the third quarter of last year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. And they don't spend too much in CapEx. The most they spent was $4.4 million in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And since they have negative free cash flow, they need money from somewhere to fund their operations. So they're doing it with debt and equity. They issued $37 million of debt in 2019 and $32 million in 2020. But it looks like they're paying down a lot of debt. When a company has negative operating cash flow, they shouldn't be using much debt to fund their business. They should be using common stock. And that's the main source of their funding. They raised $69 million of stock in 2019, $184 million in 2020. When a company issues common stock, it dilutes the current shareholders and makes your shares less valuable. Here's a breakdown of their operating cash flows from their 10K. This shows us the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate CFO, you start with your net loss. Then you have to add back the non-cash items on the income statement and adjust for changes in working capital. We start with the net loss of $164 million. Then we have to add back the depreciation and amortization of $2.2 million. We have to add back the $23 million of change in fair value warrants. Only a company can issue warrants on its stock. Warrants are long-dated options. If the company sold me warrants, that would give me the option to buy their stock at a predetermined price. If the company sold me warrants to buy the stock at $20, and currently the stock is trading at $16, so I'd rather just go into the open market and pay $16. But say the stock price jumped up a lot next week to $25. Then I could buy the stock for $20 a share from the company, even though it's trading at $25. Then right away I could sell the stock for $25 in the open market, pocketing a $5 profit. When I exercise my warrants, it increases the shares outstanding, so warrants are dilutive. When regular options are traded in the open market, those are non-dilutive. New shares aren't issued. So the company has to mark-to-market the warrants and pass through a gain or loss onto its income statement. But these are non-cash items. Only when the warrant is exercised, that's when the cash transaction occurs. On the income statement for the first 9 months of 2021, the company passed through an expense of $23 million in the fair value warrants. So we have to add it back here. We have to add back $2.7 million of stock-based compensation, $1.6 million of impairments, another $50 million of stock-based compensation. The company received $5.7 million from their receivables. That's a cash inflow. They bought $7 million of inventory. That's a cash outflow. They had a cash outflow of $17 million on prepaid expenses. That means Luminar made an advance payment for a product or service it's going to receive in the future. When they actually receive the product or service, then they'll remove the prepaid expense from their balance sheet and pass through an expense onto their income statement. Even though they reported a loss of $164 million, they actually lost $94 million of cash flow. Let's look at their investing and financing section. This shows us the first 9 months of 2020 versus the first 9 months of 2021. They received $358,000 from the acquisition of Optigration. They purchased $530 million of marketable securities. They received $307 million from the maturity of marketable securities. They had a cash outflow of $4.2 million from property and equipment. Here's a list of all their property and equipment according to their balance sheet. The book value is $11.1 million, which is $20.7 million minus $9.6 million of depreciation. $10 million is machinery and equipment. They have $3.3 million of computer hardware and software, $1.7 million of demonstration units, $1 million of leasehold improvements, $800,000 of vehicles, $600,000 of furniture and fixtures, $3.1 million of construction in progress. In their investing section, they had a cash outflow of $144 million. Let's look at their financing section. So in the third quarter of 2021, they raised $153 million from selling warrants and $4.7 million from selling stock options. In the third quarter of last year, they raised $170 million from issuing convertible preferred stock. In their financing section, they had a cash inflow of $158 million. This is the equity section on their 9/30 balance sheet. They have $539 million of equity. They raised $1.3 billion from selling their business, and they lost $749 million from running their business. Let's look at the capital structure. They have $539 million of equity, $12 million of debt. They're 98% equity, 2% debt, and they have lots of cash on their balance sheet. I gave them the lowest whack on Finbox, 6.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated over 7 years of future free cash flows. We estimated a terminal value, which is all cash flows past year 7, that's $4.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.1 billion. We divide that by 362 million shares. And we get a calculated stock price of $8.47. They're trading at 16, so they're trading at a 91% premium. It's a sell according to the model. Their revenue growth is projected to be 73% a year. So I grew their revenue 73% a year up through 2028. That's how I got their future revenue estimates. To get their future free cash flows, I looked at similar companies, and it looks like a bunch of companies convert 15% of their revenue to free cash flow. So I multiplied their future revenue estimates by 15%. That's how I got their future free cash flows. And I estimated they would have negative free cash flow through 2024. It is really difficult to value a company that doesn't have much revenue. So at this point, it's anyone's guess. And for a company like this, you generally wouldn't do a DCF calculation. The value is just what people perceive the future of the company is going to be. Since they're not really generating much revenue, and it's really unknown how much revenue they will generate in the future, it's really based off of market sentiment. So whenever this company earns a new contract or builds another relationship with another car manufacturer, that's a step in the right direction, and that's when you'll see their stock go up. But if you don't hear much news from the company and they're not getting many deals, then it's likely the stock will go down. So it's definitely a tricky investment, but if you're confident about the management and about their technology, then it's a good investment. But if you're not sure, then I would just move on. Simply Wall Street values the company at $24 a share. They're saying it's 32% undervalued. 6 analysts priced this stock, and the price target was $29. The low was $17, the high was $38. Before a SPAC identifies an acquisition target, their stock trades at $10. Once they announce they're going to start the acquisition process, then the stock jumps way high. As you can see, it hit about $50 a share. And when the price gets high, a lot of people who held the stock before the acquisition want to cash in, so they sell off their stock. Then when you see someone selling a lot of stock, it's kind of a domino effect, and the stock price keeps going down. But the stock is trading above $10. I've seen lots of SPACs fall way below $10. And you can see all this buying activity right here where the stock jumped up. That was in November. In the beginning of November, there was an announcement that tech giant NVIDIA and Luminar are pairing up to put self-driving hardware into cars. NVIDIA is one of the largest semiconductor companies in the world. It's a massive company. The article says it's a huge deal for Luminar and shows investors the development of autonomous driving technology is going to accelerate. So NVIDIA chose Luminar out of all the other options. It should provide you some comfort if you're investing in Luminar. In Luminar's third quarter report, it talked about NVIDIA is pairing up with Luminar's Iris Lidar. This will enable long-range 3D sensing capabilities. They have a beta of 1.27, so the stock is a little more volatile than the market. It's gone down 46% in the past 52 weeks, while the S&P is up 26%. The 52-week low was $13.45, the high was $41, and the stock is trading below its 50-day and 200-day moving average. 5 to 7 million shares are traded each day on this stock. 35% of the shares are held by institutions, and over 9% of the shares on float are shorted. Luminar had about 375 employees last year. They're up to 500 now. If you invested $10,000 into this company when it started trading, you would have been over $35,000 a few months back. But if you're still holding on, you'd be at $15,200, which is not too bad. It's a 52% total return or 17% annualized return. It seems like there's some insider buying. 4,500 shares, 23,000, 16,000. 37% of the shares are held by the general public, 32% by insiders, and 28% by institutions. Luminar's CEO owns 28% of the stock. His valuation is $1.6 billion. Then Vanguard owns 5%, GVA Capital 5%, G2VP 3%, and the Monetary Authority of Singapore owns 2.6%. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a really bad price to sales since they're not bringing in much revenue. Their price to book is about 11. Here's a list of their non-current assets. 11.1 million of property and equipment, 10.2 million of operating lease right-of-use assets. So they're leasing assets from another company, and the value of those assets is $10.2 million. 2.5 million of intangible assets, 3.1 million of goodwill. Goodwill is the premium a company pays when it acquires a company. It's the premium above their net assets. And 2.5 million of other. They have a really high current ratio and quick ratio above 17. They have 129 million of cash on their balance sheet, 416 million of marketable securities. So they have about 540 million of cash because marketable securities are highly liquid investments. 8 million of inventory and 24 million of prepaid expenses. They have 10 million of accounts payable and 19 million of accrued and other current liabilities. Also 4.9 million of operating lease liabilities. Here's a list of their accrued and other current liabilities. 6.2 million of accrued expenses, 1.7 million of warranty liabilities, 7 million of accrued compensation and benefits, and 3 million of employee tax withholding. Accrued liability or accrued expense, it's pretty much the same thing. This occurs when a business has incurred an expense but hasn't paid it yet. Payroll and payroll taxes are a common type. Because companies are accruing these expenses throughout the month, a company doesn't pay employees in advance, and they don't pay employees every day. The employees have to work for 2 weeks, sometimes a month, before they get paid. Even though they had negative 127 million of free cash flow in the trailing 12 months, they do have a good amount of cash on their balance sheet from the IPO. They have 545 million of working capital. Working capital is current assets minus current liabilities. So it looks like they have enough cash to get through the next 12 months without doing another capital raise. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 38 companies in the same industry as Luminar, and their ratios are pretty weak since they're not bringing in much revenue at this point. We can't look at the PE. They have a really high price to sales. Their price to book is better than average. They have a really high current ratio. They have a terrible ROE. They don't have much debt. And they're not a small company, 6 billion market cap, but they're definitely smaller than average. So to summarize, I have them trading at a 91% premium. But like I said earlier, it's almost impossible to value this company. This could be a huge, massive company one day, especially if its technology is used in a lot of EVs. Of course, you have to worry about competition, but the fact that they're building relationships and they've already gotten some revenue is a really great sign. I rank their free cash flows, revenue, and ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.